I would like to invite Sheila Moraa and Maina to please come to the stage. We're really excited to hear about Acorn. Are you in the room? There you are. I'm looking and looking. Everybody talks about your project, and we would like to know exactly what's going on and how you've managed to blend your structures so that you can then deliver the housing that you're now doing. So thank you so much. Great. Come on through. This is the clicker. Yep.
Thank you so much, Keisha, for having us. Good morning, everyone. No, sorry, it's afternoon. I think we have the easier job to just say what the earlier panel talked about, and in terms of how we've actually brought this to life. So my name is Sheila Moraa. I work with Acorn Holdings as the executive director handling the development management business. And we'll do this together with my colleague, our executive director handling AML, Maina. We're doing this on behalf of our CEO, who unfortunately couldn't be here, but passes his regards. So I'll get right into it, and I'll basically just tell our story. I'll do the first part, just focusing on the technical construction bit, what affordable housing actually is to us, how we've defined it, what we've been able to do, and then Matthew will do the interesting bit of actually talking of the instruments we've used to actually blend finance to make this work for us. So we are a vertically integrated real estate developer. So that basically means we are a developer, we're an operator, and we're also a manager of rental housing. So we take the projects from the inception phase, the land, the design, the construction bit, we handle the operations, and Matthew and his team then manage the rental housing from a REIT's perspective. What's our purpose as Acorn? To create vibrant communities, residential communities, and to be able to deliver exceptional living for the young students and for the youth population that we are focusing towards. This is basically a snapshot of what our journey has looked like for the past about 2.5 decades. In the beginning, we were consortia in 2001, basically offering project management services to third-party clients. And we've been involved in some of the notable developments. We had Coke in Upper Hill. We were able to do Deloitte. But then really the strategic shift for us happened in 2015 when we partnered with Helios Investment Partners. And at this point, we then took on the heart of being developers with a focus on providing rental accommodation to the young people of this country. And we are focusing on student accommodation. And so in 2017, we were able to launch the initial product, which was Kwetu. It's a brand of student accommodation that's been established here in Nairobi. To be able to facilitate this, we then launched the Green Bond in 2019 at the NSC. This was then cross-listed at the LSE, the London Stock Exchange, in 2020. And in 2021, in our journey of figuring out this whole blended finance, we were able to launch the REITs. So we've got the development REIT and also the income REIT, which were launched in 2021. And in 2024, just because of the gap in the market, we were able to launch the second affordable product, which is Kijani. And we'll talk through that as we carry on with the presentation. So what were our drivers, or what underpinned why we got into the sector that we got into? So this has actually been influenced by 3 major tailwinds, and that's urbanization. And we see in Africa generally, there's a positive trajectory, in urban population growth, which is now at about 4% if you look at the past 10 years. And then also the growth rate, which has also been influenced by the rural-urban migration, has continued to remain steady. From a demographics perspective, the median age really across most of Africa's cities is about 18 years. In 2014, 10 years ago, 18 years, still at about the same place. And if you look at, again, the demographics, you've got a very huge chunk of that population that's below the age of 35. Currently at about 65%, and that's in Nairobi. And it's the same story across Africa. And if you look at the economics, it points to affordability being for a rental, or rather a renter's market. Because if you look at 2014, we had 69% versus 26% of renters versus owners. And this is very clear, even across, if you look at the mortgage uptakes across the various African cities. And so when you look at how then, we're able to provide something that's affordable, if you look at the expenditure on housing and utilities, again, it's at a massive rate of about 36%. That was 10 years ago, and 39%. So for us, these are really the tailwinds that have continued to ensure that we're able to roll out affordable housing, and that there's actually a gap and a need for this. Why have we focused on student accommodation? So in 2015, when we partnered with Helios, what we realized is that the gap was in provision of institutional grade student accommodation. Because you've got, all manners of providers offering the other residential rental accommodation. And so we focused primarily on provision of student accommodation, and the numbers, clearly tell the story. If you look at the past about 25 years, in 2000, we had the enrollment at tertiary institutions, and this is just the public universities and private universities. This data excludes the TVET institutions, was about 50,000, but then we've had about 8% growth rate across the years till where we are at today. And if you look at today, we have about 650,000 just in the university institutions, with provision of institutional beds at a meager about 30,000 beds across all our institutions. So this just speaks to the gap that there is, and this is really what has driven the Acorn story, that there is actually a gap. We've done extensive market research on this, and so we're rolling out accommodation to be able to provide and to supply decent accommodation to this. When we look at real estate from a housing perspective, we've been able to, globally, this is divided into different sectors based on the ages. And so you have your PBSA, which is purpose-built student accommodation. We've got then the build to rent that caters to families. And later on, you've got senior living. Now, where our macros and where our demographics actually point to where the gap is within the first three areas. That's the age group between 18 to about 32. And that's student housing, provision of accommodation for young urban professionals, and also the starter homes. Now, when you look at the first three classifications, they would predominantly rent the accommodation, especially in the Kenyan and in the African context. And then once people have gotten their first jobs, they're settling into families beyond the age of 32, they start then to own their accommodation. And this is really what has driven why Acorn does what it does, focusing on rental accommodation for the young people, because that's really where the gap is at currently. So I'll just quickly walk us through how we've been able to execute our strategy from a model perspective. And this really has evolved over time. When we began in 2015, we didn't know this is where we would end up in. But this is how we've now been able to model the business, and we're able to then roll this out and scale the accommodation in a successful and efficient manner. So we've got the management platform. If you look, that's the blue side, the left side on your screen. And this is basically how we're able to then deliver these properties, these projects. So we've got Acorn management that does the development and does the operations. And then we've got the investment management arm that's run by Matthew, and that's what then helps us, with funding and the REIT management. Now, Acorn Holdings is also a co-investor in this. If you look at the middle bit, we've got the tax-efficient portfolio vehicles. Because we realized to scale, we can't go the traditional route of getting finance for one property, build, finish, go back, get finance for another property. So developed the REITs in 2021, and my colleague will talk more into that as it comes. And then, as the earlier panel had talked about it, it's critical to identify different and multiple sources of financing, and blend this then together to come up with an attractive opportunity, or to be able to have projects that then have impact. And so we've been able to map out what that looks like. And so from the equity side, working with the local pension funds, we've also been able to launch a retail product called VUCA, which also provides equity, and then working with global investors, and we'll talk about this as we carry on in the presentation. And then to be able to, answer on the debt piece, working with DFIs, and also working with local and international banks. So this is where our story has led us to. And from 2015, we now have 20,000 beds, 8,500 under development, so at different stages of construction, pre-development design, and we've got 12,000 beds actually under operation, and that's just a sample of some of the properties that we've had. Long-term plans, so we look at this from a three-pronged perspective. So market penetration, because locally, people know Kwetu and Kejani just in Nairobi, but then we are also going into other cities. We've just broken ground in Eldoret. We're getting into Kakamega just because of student population that's available in those cities, and also to look at other towns like Thika. And then we also have a new segment offering. If you remember the global classification of housing, there was the Beton, providing accommodation for young professionals, people who've just finished university and are looking for their first homes. So we're launching that, which we call the build to rent segment. And that should be launched towards the tail end of this year. And then we've also begun some work on regional expansion, tapping into other regional markets, and we've done feasibility studies to look into doing the same thing, providing rental affordable accommodation in Uganda, in Rwanda, and in Tanzania. So I think now we get to the crux of the matter, and I'll invite, as Matthew walks to stage, I'll just talk about our approach to blended finance. And so this is still very nascent in terms of it actually being utilized in Africa and in our country. And so we looked at this again from a three-pronged perspective. We first had to identify impact-driven projects, because for you to be able to access concessional funding, you have to be able to demonstrate impact in some shape or form. And so for us, it's to be able to roll out green and affordable student accommodation. And the structuring of blended finance, Matthew will go into the details of this, but it just piggybacks from what the earlier panel talked about. So layered capital structure, how we've used guarantees, to lower the perceived risk of the instruments, and to be able to crowd in private investors, and then also just partnerships by using technical assistance facilities to be able to fund some of the upstream work that had to be done, and also the setup costs for the platform. Matthew will talk more into detail about the different financing instruments that we've been able to use throughout our journey, the debt funds, the equity funds, the commercial and the concessional debt. And then finally, for you to be able to get, even after having done a proof of concept and having demonstrated, through a decent track record, what we've realized has been critical to our success is just being able to measure and report the impact that has come out of, especially the use of concessional funding into our portfolio. And so we have annual green bond reports that we would do, sustainability reports, and this was actually pegged on very clear matrices on the ESG front, and also having global certifications. And finally, a commitment to transparency in terms of how we do our disclosures and on the governance bit. So I'll ask Matthew to just come and talk through what we've actually done.
I think I need no introduction. I'm the Matthew. So I'll talk about our blended finance journey. So I'll take you a little bit back. You saw the capital stack that she spoke about in terms of all the capital providers into our business. So 2015, journey begins. Helios comes on board, builds the first phase and supports us building the first phase, which is what you're calling the seed phase. And the seed phase was a proof of concept phase, because we did start building in our own lands. We did projects in Jogoo Road, Raraka, and then parklands, and then at that particular point you had to build development experience, operational experience, so that when you're going into the establishment phase of the capital market instruments, you'd be able to say, look, we've built some track record and there's some bankability in what we're doing. So then we entered the second phase, which is where the green bond sits, which is the establishment phase. So in 2019, when we were launching the REITs, people thought we're crazy. Early on in 2017 to 2018, 2 commercial banks just collapsed with a corporate debt instrument. I won't mention who those are, but you know them. So when we were coming back to say we're going to do a green bond, I think 3 transaction advisors pulled out and said, we are not going to do this because we're not going to be the ones to, have a failed instrument. But we knew that to be able to scale, we had to do something. Someone mentioned about, interest rates, and we knew that in trying to develop the next 8 assets, we had to manage our cost of debt. And the only way to do that in a volatile environment like we were in Kenya, we had to get an instrument that would give us fixed cost of debt. So the first thing that we did was we knew that we were going to do, it was a corporate bond, it was a green bond. At that time, Kenya didn't have legislation for green bonds. So we had to work with they had legislation for corporate bonds and corporate instruments, but there was no green bond legislation. So we had to work with the CMA, which is a capital markets authority, to develop legislation that would permit us not only to issue a corporate bond, but one that was also green. So we issued at the time a $43 million ticket bond. And if you've ever issued an instrument to the time of closing, some are giving you money, some are not, you're always tense. We closed with $43 million, October 2019. And that became the first phase. It was a 5 billion shilling issuance or a $50 million issuance at the time. Then we had about subscription to $43 million, which for us was quite successful because we knew, coming back from, failed corporate bond issuances, if we closed at $20 million, that was good enough for us. But we hit $43 million, we closed that, and then that was towards November of 2019, if I remember, yeah. And then we cross-listed on last week of January on the LSE, and then COVID happened. Now you have money and you have to develop. So also that then became, then what are you going to do? So we developed about 4 assets at the time. The green bond was meant to develop 10 assets. We've developed 8 because 4 of those assets are behemoth projects. When you look at Karen project and you look at the Chiromo project, they're massive, 2,500 beds. I think Chiromo is the largest student accommodation dwelling in Africa, 2,600 beds by itself. So we build the green bond. But there are a couple of things as we were doing the green bond we needed to do. One was we needed to de-risk the bond because investors, pension funds, local fund managers, international guys were like, we're not touching you if we do not have guarantee for our money. We just lost money 2 years ago. So the first thing was that we worked with a DFIs, which is Beach, through Garantco to provide a guarantee on that bond, 50% guarantee on principal and interest, and at that particular point provided a de-risking mechanism from the word go. And that's what actually allowed us to move from a target of $20 million on close to $43 million on close. So obviously the de-risking factor plays a key and significant role on that front. Then in 2021, what we did is we upsized that bond to a 5.7 billion shilling, or then to a $57 million bond. It was oversubscribed by 139% when we came back for the second tranche, purely because of the de-risking factor, and also the fact that a lot of the local pension funds and commercial banks, at that time, that rate was fantastic and it was attracting because we issued it at a 12.5% rate. So I think for us, what was very key as well on the upstream work was, getting the catalytic and the de-risking factor from EAIF, which anchored 30% of that bond, and that was very significant on that front. The guarantee by Guarantco, 50% on interest, 50% on the principal, was a no-brainer for the guys to come in. And then a lot of the technical assistance work was done by FSD, because remember, at the time you don't have legislation, and there's a lot of work that has to go into changing those legislation to permit the green bonds. And importantly as well, the instrument would only make sense if you had local participation. So you had local investors come in, deploy capital. On the first phase was commercial banks and pension funds. On the second tranche was purely commercial banks. And so that was quite significant for us to build that. And there's a lot of takeaways that we built. I think there's a lot of concerted effort that we had to put in, both from the regulators as well. It was a first for many of those regulators, NSC, you had CMA, you had also, you had to work with Parliament as well in terms of enacting some of that legislation to ensure that anyone else who was going to come back and do green instruments also would benefit. I think importantly as well for us, what we see and was very critical was also just getting local capital into this instrument. And if you raised any corporate bond in the market, nobody was going to touch you unless you were government. So just bringing back that market confidence was very, very important. It wasn't rosy, and I'll talk about, a little bit about that. So we announced ourselves into the market through the green bond, and we knew that capital markets was where we saw a lot of that capital stack coming from. So first 2 years on the green bond, then we issued the REITs. And we knew the REITs was where a lot of the blended finance was going to happen. So green bond going on 5 years, first part of the seed and establishment phase, going into the establishment of the REITs. You had committed debt that you would draw down. You now needed to raise the equity. So enter the REITs in 2021. And again, a couple of things we had to do, and that was very, very important, was regulations. REIT regulations in Kenya were promulgated in 2013, so by the time we were launching our REITs, there was only one REIT in Kenya. One REIT had launched, one REIT had tried to launch and failed, and then here we are launching the first D-REIT, and people don't know what a D-REIT is. And then nobody has ever operated a D-REIT. And then here you have an income REIT, and it's specific to a specific sector, which is PBSA as well. So the foundational work specifically had to follow 3 processes. And the last one is really where we are. Policy and regulation, we had to align a lot of tax legislation to the REIT regulations because there was no harmony there. So tax legislation was saying one thing, REIT regulations were saying another thing, and so you have to sit between the Revenue Authority, the Capital Markets Authority, and yourself. So harmonization had to happen at that sense. Then there was the building the platform and making sure that you build the infrastructure that was bankable, and the instruments themselves, you had to provide an exit mechanism, which was very critical to provide visibility of net asset values and transparency in terms of reporting, and that made we had to list these REITs on the USP, which is the unquoted securities portal. I won't go into the details why you don't list a REIT largely on the main market because of the volatility in equities market. So we put it out on the USP. And then we had to do a lot of market education. Remember, there's only one REIT, and that REIT had some fundamental challenges. So you're issuing a REIT. The first REIT was listed on the public markets. Our REIT is listed on the unquoted market. So you have to go through a lot of market education, especially on the institutional side. They had deployed capital across multiple asset classes, but here is a new asset class. They don't know about it. How would they embed net asset values into their overall fund values and things like that? And then later, we knew that the biggest reason why you list a REIT in the public market is to allow early on investors to exit and secondaries to come through. So we knew that we didn't want to touch and have volatility in the net asset value, because that then would ruin the bankability of these instruments themselves. So then we created a retail platform. And that retail platform then was going to allow, as it grows, retail investors to participate and show that you have now gone through concessional, institutional, and retail. And that's where we are. So as we did that, we had a couple of friends and a couple of good funders. On the right-hand side, I think you can see the concessional capital that came through. You had PEAGE supporting us, Infraco specifically anchoring the REITs when we launched them. EAIF anchored the green bond. Infraco anchored the REITs, and that was very important. And then you had local pension fund participation, and you'll see later we have more than 38 pension funds today investing in the REITs, and they've given us more than $60 million in the last 4 years. On the right-hand side, we had to do umbrella sort of debt commercial structures. The green bond was coming to an end in 2014, but we knew then we had to continue developing. So we entered into umbrella arrangements for debt instruments with some commercial banks where they would fund on a drawdown basis similar to the project-linked bond, the next 10 projects. And those would be on the left-hand side. Here is a list of some of the pension funds that have participated and continue to participate. $60 million deployed to date in that capital stack, over $62 million from 38 pension funds. Then comes results, because then people they can't give you money and say, look, we've done our bit, and you have to deliver results. On a dollar term, I think about 28% to the dollar return the last 4 years. We've paid more than $11 million back in distributions back to our investors. So it was a journey of creating the seed investments, the establishment phase where you had to go through legislation, you had to build a track record to attract concessional capital, de-risking, and the catalytic part of it, and then commercial capital from your local pension funds, insurance companies, and eventually retail that then sees that it's a good investment, especially from an operations perspective. And then we've entered growth phase 2. In growth phase 1, in growth phase 1, we raised capital on the go. Because when you have a new instrument in the market, you have to prove that it can work. So you don't get committed capital, and that becomes a challenge. You can get committed capital in debt, concessional debt, and commercial debt, but getting committed equity is a main challenge. Infraco had come in, put in and anchored their committed capital, and it's a one-off. So getting local participation, you have to raise capital on the go, and it's hard, tedious work. And so that was growth phase 1, where you've built 20,000 beds by raising capital on the go, and now you're entering growth phase 2, where now you're looking at committed capital from commercial investors, concessional equity, and importantly, one big DFI, DFC that will provide debt so that we are able to manage the volatility of interest rates, especially on this part of the world, over the next 18 years. So now you have committed debt that you can deploy into the projects, because we do a debt to equity mix of 35-65 into the project, 65 debt, 35 equity. So the debt side is sorted. And now you're moving towards growth phase 2, where you're looking for committed equity. And that will come from 3 or 4 major social security funds over the next 5 years. And also you'll have concessional equity that is deploying capital in the DREIT in the form of mini portfolios going forward. So therefore you have raised the first phase, establishment phase, where you're coming through to the de-risking factor of the green bond, the de-risking factor of a new instrument in the REIT, and now you're attracting commercial and retail capital into committed capital going forward. This is one of those projects, and that's the Acorn Housing Equity and Debt Fund that will have both concessional and commercial capital. Sheila, you want to do this? Yeah. So now we've built with the regional, we'll build locally with the pension fund money, with DFI money and commercial capital. And we've now done Nairobi, and now we're doing the other counties. Then there's a lot of interest for us to go into Uganda, Rwanda, but then how do you fund that? You cannot raise capital on the go in those countries. So ahead is the debt and equity fund that will give us Pan-African expansion to allow us to go there, because you will have committed debt and equity, $60 million close by end of 2026, and that will deploy capital and do projects in those countries, Uganda, Rwanda, and Tanzania. Why? Demographic dividend is the same, urbanization rate is the same. We're in the business of providing dignified housing for young people, and we see that as having significant runway going in there. Where are we today? I think for us, permanent capital becomes a key theme, thematic, also on green housing in terms of what we intend to do, and that becomes our core product. Kwetu and Kijani is what we have. On the student housing, we are launching a new REIT. It's actually been approved that will focus on youth housing, products being Palmer and Palmer Light, not Pakao, as we see that. And we see that then deploying capital, committed capital into the Pan-African expansion over the next 10 years to 2034. And I think for us to be able to scale, we've built scale